that quick for me. It's like, okay, this crypto stuff, this DeFi stuff is starting to make sense to me. I can see the applicable use cases. We're running thousands of simulations a day for our customers, looking at different market scenarios, price trajectories, liquidity scenarios, to really understand, like in any single kind of case that can happen, how does this protocol need to be parameterized in a way that it avoids those insolvencies, should we see market shocks, et cetera. But again, also in a way that's not too restrictive and allows these protocols to grow. There's always going to be risk in any system. No system is risk-free. We try to get as flexible as possible to align with those we want to work with, because if we're trying to work with you, we generally think that you're a protocol that's going to grow.
Hello and welcome to the Protocol Services Podcast, where we interview a lot of the specialist teams from risk advisors, treasury management, consultants, all providing critical services to a lot of the top decentralized protocols building the future of Web3. I'm your host, Jack Purdy, and with me, I have Matt Dobel from Gauntlet. Welcome, Matt.
Yeah, Jack, thanks for having me.
I'm absolutely excited for this conversation. So to kick things off, we first met, this would have been a little over 3 years ago, I believe, back when you were still at Square. So maybe we can just jump in there and kind of talk to me how you went from sort of the enterprise BD world into crypto and then to Gauntlet in specific.
Sure. So yeah, I was in fintech for a long time. Coming out of college, did a little bit of like private equity early on and found my way to New York to the fintech world. And I think back in 2016, I was managing a sales team at a fintech company, and I noticed that like everybody was trading crypto at this company. And also we were starting to partner with blockchain companies. And so I figured like I might as well look into this technology and kind of see what's going on. Got bit by the bug a little bit, still probably own some EOS in a wallet somewhere that I can't find anymore. And I thought it was really interesting, but at the time it felt like really much like definitely like a casino. For me, I was like, all right, I'm not ready to like commit a ton more time to this, but I'll keep an eye on it and see how it goes. And so kind of kept on in the fintech world, went to a couple companies, ended up at Square. I was building out and kind of managing a strategic account team focused on enterprise business. And that was right around like COVID, DeFi summer, everything. We were all working remote. I had a lot of spare time on my hands. And so I saw, Compound's white paper, which I think a lot of people did, that kind of propelled them into the space. That quick for me is like, okay, this crypto stuff, this DeFi stuff is starting to make sense to me. I can see the applicable use cases. So I started using Compound quite a bit. And I don't know if you remember back then, but the incentives that Compound was paying on the markets were pretty nice. So I was levered up, farming incentives, enjoying the ride. Compound was doing really well, and I'm still very happy that they're around to this day, and they're definitely a valued partner of ours. But at the time, somebody had pushed a proposal that like basically started cutting incentives. And as somebody who was farming those incentives, I wasn't too happy about that. So I started digging in and found that Gauntlet had done some analysis around this that led to some of this emission cut. And so who is this Gauntlet company? So I went in and kind of looked at them, and that's how they initially got on my radar. But eventually at Square, I was like, all right, I need to make a full-time jump into crypto. So started looking around for companies. That's actually how you and I met, which is really funny. And I'm glad that we've kept in touch to this day because, one of the places I was interviewing at was Messari. So met you and Ben really early on, had a bunch of good conversations. And at the same time, I had remembered Gauntlet. From what I remember, I was like, these guys are doing some really cool stuff. I don't really understand all the math, but that's probably needed in a space like this. And so reached out to Gauntlet, had a bunch of conversations, probably talked to them for about 6 months on and off, just given I had some bad startup experiences before. So wanted to make sure that they were the right fit for me, but importantly, like I was the right fit for them. And it got to the point where I was basically just like begging them to let me join. And so, luckily they let me come on. We were pretty small back then. We were probably around 25 people or so. But ever since then, it's been kind of a wild ride.
Yeah, absolutely. That's a cool kind of organic story, being involved in like the early yield farming days with Compound. I mean, that was really well, it kicked off all of DeFi summer. I mean, I think Synthetics might have had an incentive program before, but it was like really that summer where that sort of just like opened Pandora's box for DeFi protocols kind of throwing tokens. And I guess led to the need for a lot of like Gauntlet's, risk management incentive services to this day. So it's really cool. In those early days, was it somewhat intimidating joining like a very technical team, or did you feel like there was a really big learning curve to kind of just get up to speed with all the services being provided?
There was definitely a learning curve with some of the more complex math that Gauntlet was doing and still does to this day. I still can't tell you that I understand everything our data science team is doing at a super deep level. I do have a finance background, and so I understood at a high level what they were looking to accomplish. I'm familiar with high frequency trading and other types of trading, and that's where a lot of Gauntlet simulations kind of developed out of. So I knew what the end goal was, and I knew the value they provided. it took me a little bit just to get up to speed on specifically, what was kind of going into baking that cake. But over time, kind of started to figure it out. I mean, the team was great. I mean, we have a saying, which I'm sure a lot of others do, like there are no dumb questions. And thankfully that is true at Gauntlet, because to this day, I still probably ask very dumb questions all the time. But, part of working at a company like Gauntlet is you have to be a little bit fearless and ask those questions, because if you don't, you're never going to learn. And then you get enough at bats, you talk to enough people, you spend enough time with the team, and you start to pick it up, and it starts to become second nature. And so still learning a lot every day, as even today, but definitely have started really understanding a lot of what we do, and furthermore, just, a lot of the value we're providing to different types of customers.
Yeah, absolutely. That's the beauty of surrounding yourself with people smarter than you. You kind of just end up getting to pick it up through osmosis, and a lot of gigabrain folks in crypto and over at Gauntlet as well. Talk to me a little bit about Right When You joined. Like, what were the core services being provided, and how has that evolved over the 3 years you've been there?
Sure. Gauntlet looks night and day from what it did 3 years ago, and a little bit of change from when I joined. Back then, our risk management business was primarily focused on parameter tuning, optimization, off-chain agent-based simulation, working with the really large money markets like Compound, Aave, and others, and helping ensure that they were finding the right balance between managing risk and avoiding insolvencies during market volatility, but also driving capital efficiency. Because at the end of the day, you want these DAOs to grow, generate revenue, and ultimately, stick around for as long as they have. That was the main product. When I joined, we were starting to build out our incentive optimization product as well, which essentially what we did and what we continue to do is work with protocols that are running incentive programs and deploy user behavior models, elasticity models that basically help them better understand the relationship between changes in incentives and user behaviors, and help them find that right equilibrium where they're not overspending for growth. They're spending just enough to where they're getting maybe more than $1 from the incentive spend that they're spending, without kind of sacrificing for growth and needing to pay too much for that growth. And so that was the earliest stage of that product. And we initially started working with some DEXs. We worked with SushiSwap back then. We worked with Balancer. That's evolved quite a bit over time, become far more sophisticated. It has really grown into its own team at this point. Today, we look very much different from, maybe the two product business that Gauntlet was back then. When I joined, again, we were about 25 people. We're up to 75 people or around that today. And the way I describe Gauntlet is we kind of roughly break down into three areas. And the first area is risk management and protocol optimization. That's our bread and butter. That's what we're most known for. That kind of dates back to those Compound days where, again, using off-chain agent-based simulation to inform on-chain parameterization for different DeFi primitives. Still primarily, lending protocols, doing a little bit of our own parameter tuning directly on things like Morpho, but also have expanded into new verticals. So also working with folks like Perennial, working with folks like Jupiter, continuing to expand out in the perpetual space as well. The second area of the business is our applied research team. And they're focused on two main things today. Half that team is fully dedicated to restaking. And so, one thing as restaking has, it's huge now, but as it was popping up, a lot of people were asking the questions like, what is restaking? What is the future of restaking? What is all this math that we haven't seen before? One of Gauntlet's value props is, we can kind of look into these unknown things and really use a lot of our experience, our talent, simulation, and breadth of knowledge to help decipher a lot of this and help bring more understanding to it. I think that starts at the top with Tarun writing as much research as he does on a consistent basis. So really dove in and started working with folks like Eigenlayer, some of the LRTs like Puffer and Swell, had done some work with Renzo and EtherFi. Now working with even more restaking protocols, continue to dive in more. And especially now with slashing getting a little bit closer, things coming more online than where they were maybe 6 to 12 months ago. Now is when the fun starts. So we've done a lot of this kind of background work and theoretical work and helping get these protocols ready. And now it's more about the ongoing dynamic parameterization and decision-making to avoid things like slashing events, to avoid things like DPEGs, collateral at risk events, et cetera. The other part of that team is focused, again, on just continuing to build out that incentive optimization business. So I've been fortunate to work with folks like Uniswap, Immutable, Tansi, Cove, and a host of others on just fine-tuning incentive programs and helping them grow. The third area of our business is Era Finance. So Era Finance is a protocol that Gauntlet incubated. It is now spun out. It's a separate foundation board entity. But Era is really focused on treasury management and treasury operations. And so the reason why we did this is after working with DAOs for so long, what we really saw was kind of a trilemma in treasury management between one, something that is non-custodial. Like you should always have access to your money. Nobody else should. You should be able to deposit and withdraw as you please. Two, something that's autonomous. And so once you define your objective function of what you want to be doing with your treasury, you don't want to always have to go back to a DAO for a vote on how to rebalance this or what should the mix be. I think we see on-chain coordination is still relatively slow. There's misaligned incentives among voters, and that can cause drastic swings in treasury values if you're holding only volatile assets or you don't have a very pre-planned strategy. And then lastly, something that's fully on-chain. So kind of sticking with the DeFi ethos of being on-chain, verifiable, transparent. So that's what kind of led us to build Era. And so Era has been live in market for a couple quarters now, has been growing quite steadily, and have been really happy with onboarding new DAOs, onboarding existing customers on the Gauntlet side as well, and just continuing to expand that.
Got it. So lot to cover here. I'm excited for this. So maybe starting with bucket number one there, could you maybe just describe to the layperson a bit more about that agent-based simulation and what that means and kind of entails?
Sure. So, and I'll use Compound as an example. They've been a long client of ours, and we really value that relationship with Compound and the DAO. So Gauntlet was really spun out of, Tarun and Ray, our CTO co-founder, and John Morrow. And prior to Gauntlet, they were doing a lot of incentive optimization, high frequency trading. And so essentially, if you think about what a high frequency trader does, they are looking for tiny little trades that are profitable in a market and then executing a lot of those trades. But prior to executing any of those trades, you have to run simulations to see how profitable they're going to be in certain scenarios. So you're not just looking at best case or worst case, you're looking at edge case, black swan. You're looking at different actors in the system like Byzantine, altruistic, rational, irrational, and really understanding are these trades going to be profitable? So, I think what Tarun and Ray and those guys realized is, you could port that over to DeFi. And instead of finding little inefficiencies to exploit among DeFi protocols, you can actually use it in a way to parameterize protocols in a way that makes them more resilient against volatility and more resilient against traders who might be looking to do that via price manipulation or otherwise. And so we built a proprietary simulation SDK in-house that, as we ingest protocol data, chain-wide data, et cetera, we're running thousands of simulations a day for our customers, looking at different market scenarios, price trajectories, liquidity scenarios, to really understand, in any single kind of case that can happen, how does this protocol need to be parameterized in a way that it avoids those insolvencies? Should we see market shocks, et cetera? But again, also in a way that's not too restrictive and allows these protocols to grow.
Got it. So you're almost creating these, theoretical worlds where you can try to break the system and then do this thousands of times such that you can kind of optimize the different, quantitative parameters to make the system run smoothly and hit a point where they're not going to blow up.
Yeah, and that's what results in kind of the optimal parameter outputs on any given kind of time frame. And so that are things like liquidation incentives, liquidation thresholds, collateral factors, interest rate curves, supply and borrow caps. We also use our analysis for asset listings, delistings, et cetera. And so it's not just something you can set and forget. As we've seen, some of these protocols have had stale parameters that leads to these types of exploits or market manipulations. Something you constantly have to be doing and fine tuning these parameters in order to stay in line with liquidity conditions, which I've seen in DeFi, have been quite volatile.
Mm-hmm. And so why don't teams do this themselves, right? Why can't they just, hire a couple of risk guys, have them, create a simulation and then use that to inform these decisions?
Yeah, it's something that DAOs ask us sometimes too, and we go to DAOs and talk to them about this. And I think it's a number of things. I think one, hiring a couple of risk guys to build simulations it makes it sound really easy. And, I think in a perfect world, it would be that easy. But these simulation environments take a long time to put together. They're constantly fine-tuned by a full team of data scientists who are looking at not just this protocol data, they're looking at chain-wide data, they're looking at what's going on in other chains, they're looking at what's going on off-chain, even just as importantly, and constantly fine-tuning based on that. I think the other thing too is, there are assumptions in DeFi that don't exist in TradFi or in other worlds that unless you really know the nuts and bolts of DeFi protocols, things like that, it's really easy to miss these assumptions. And I think we saw this somewhat in the 2020, 2021 cycle where we had such an influx of traditional finance guys coming into the space and starting DeFi protocols and saying, I'm from TradFi, I know risk, I don't have to think about any of this stuff. Most of those aren't around anymore. And I think it's because of those misassumptions and kind of the lack of understanding. I think something as novel as a liquidator and liquidations are something that you don't see in a traditional market. You have to model liquidators and liquidator behavior, understand when they're going to liquidate, when they're not going to liquidate, looking at things like gas congestion or otherwise, which I think often get missed. And so you could hire two risk guys. I think they could do a little bit of analysis, but it's not going to be something as robust as this. And if you're a large DeFi protocol or you aspire to be one, these kinds of things are table stakes if you're thinking about trying to attract large LPs, institutional capital, or otherwise. So, an analog would be, trading desk. They have risk desks who are basically looking at this stuff all the time. If you've ever been, been inside a bank or worked at a bank, they have full risk teams that are fully focused on this. These aren't like two guys. These are full teams just totally dedicated to this. And so I think it's something where you do need specialists. I think that's why you've seen, not only us, but others kind of popping up and doing this to really just help these DAOs grow. And I think, the other point would be if I'm a protocol founder, I've built this amazing protocol in a lot of cases. I don't really know how to hire a risk team. I don't really know what to look for. The guy says and does the right things, but at the end of the day, you don't really know what they know or what they don't know. So protocol founders and developers are really good at founding protocols, developing protocols, and they're good about thinking enough to care about risk. But what they're not good at is that constant fine tuning, that constant measuring, and that constant thinking about risk at this type of level to avoid losses for users. But I think we've seen that change quite a bit recently. And I think that shows with just how many teams are hiring risk managers and really talking about risk more out in the open, which for us is obviously nice to see.
Yeah, makes sense. And maybe more specifically for how you're thinking about Gauntlet as a business, do you see your guys, continuing to work with a lot of these largest protocols and then, as they become 10, 100x the size they are now, just growing those contracts? Or do you sort of see yourself and the service you provide as a more, scalable platform that you can have, 100, 1,000 protocols kind of plug into and then kind of scorch the earth and try to, work with dozens, hundreds of protocols eventually?
Yeah, that's something over the past few years we've been really focused on is, how do we productize a lot of what we've been doing and how do we not just turn it into this human capital business where you have to scale every time you add a new protocol. And I think we've done a really good job at doing that. And so from the, now our simulations internally fire internal proposals of parameter changes. They go through, a human checking process to ensure the payloads and parameters are exactly what they say they're going to be. And then we can kind of push those on to either governance for voting or directly to protocols. I think a good example of that is a lot of the work we do on Morpho and curation. And so if you look at, I think Morpho has a page where you can see how much reallocating liquidity different curators do. And if you go look at Gauntlet's page, I think we're reallocating something every 5 minutes or so. And that's not somebody sitting at their computer reallocating liquidity every 5 minutes. We're using a lot of the off-chain models that we've developed over the last 3, 5, 6 years to actually automate a lot of that liquidity management. And so we have these models that are ingesting data off-chain, running our models over it, triggering when reallocation need to be made, and then pushing those changes directly on-chain. And so you see a lot of that not only on Morpho, but a lot of what we're doing with lending protocols today, even in the form of governance proposals, or also with a lot of perpetual protocols as well. Because especially perpetuals in particular, kind of a whole different ballgame than a lending protocol. Whereas maybe in lending protocols, you don't need to change some parameters on a super tight basis, every day, weekly, et cetera. Perpetuals moves quite fast. And so you actually have that need for higher frequency. And so it's very hard to do that as a human. So you have to have these automated systems internally to do that. And so we've gradually and continue are moving more to this platform type model. And then on the other side with Era, Era again is fully on-chain service, et cetera. And we have this notion of guardians, which are the ones managing these treasuries on-chain. And so, they're using off-chain logic, making sure the vaults are running autonomously. And so Era really becomes a two-sided marketplace where you have kind of treasuries on one side and guardians on another side. And they're coming together to have, efficient treasury management and to utilize otherwise idle funds to earn, either passive or, whatever kind of requested yield they're looking for.
Got it. So yeah, that's interesting on the Era side. So when you say guardians, is another way to think about that is just the treasury managers themselves, and then are just using Era as a tool?
Correct. Yeah. So they're using kind of the Era software as a management platform for treasuries because generally, our aim is to make, their lives easier as treasury managers. And so we're continuing to build that out. We're working with a few today and, just basically telling them, hey, what do you need to be more effective on the Era platform? And so you can kind of see Era as this middleware layer right now.
So thinking sort of how these different pieces of Gauntlet fit together. So you have the risk and incentive side, this applied research, and then a treasury management product. Talk to me a little bit about how that came to be, right? That almost seems a little differentiated. Was there anything from building these other two components or what sort of put that on your radar as hey, this is a worthwhile endeavor to pursue?
Yeah. So for Era, again, it really came from experience with DAOs and seeing how DAOs were, I was going to say we're managing their treasury, but really just weren't managing their treasury. These assets just sit in these DAO treasuries, oftentimes in their native token without diversifying out of them. And governance tokens, no matter which one you pick, are pretty volatile. And so, imagine being a Web2 company and you have your corporate treasury and some volatile asset, and you still need to pay. You still need to pay your employees. You still need to pay expenses, all this other different operational overhead. It becomes really hard to do that. And I think we saw a lot of DAOs who never diversified out of their native governance token, who are no longer around because we went through a bear market. These token prices collapsed and they never recovered. And so we were seeing that, even as far back as, 3, 4, 5 years ago. And so what we said is, hey, there's got to be a better solution for this. And so that's what really led to us starting to ideate on what Era could be. And so really wanted to help, part of a lot of this is educating DAOs on, hey, you can take some of your native token. Era helps, somewhat TWAP out of these tokens on chain in a way that, it's like a kind of a rules-based execution environment where, we're doing this at minimal slippage, not impacting, the price, and retaining a lot of the value of that governance token into more stable assets like USDC or something like that. And then giving these DAOs more runway, more room to pay expenses, et cetera. And we've also seen a big outreach from grant programs as well, where a lot of these grant programs, when they get funded by DAOs, they get funded in that native token. Now, if you just hold that native token and you're paying out grants, grantees receive a lot less than what they thought they were receiving. And furthermore, grantees' expenses are denominated in USDC. They're not denominated in a native governance token. And so, you think about paying a grantee in some governance token, they're going to immediately try to sell that for USDC. And grantees' jobs are not to find the best execution on this token. And so once you start thinking about large sizes, they're incurring tons of slippage, they're losing value, it's hurting the token. And so overall, just not creating a great user experience for these grantees. And so we've worked with a couple grant platforms as well to help them with that. We've worked with some other DAOs on helping diversify a native governance token for runway, contributor payments, et cetera. And really just, came out of a lot of the work we were doing with DAOs prior to even building it.
Mm-hmm. Yeah, totally makes sense. And almost, again, porting a real world analogy to this, it's it'd be insane if a startup, right, had all of their treasury balance in their equity that, had a public price, but is clearly highly volatile. And right, so when people look on Deep DAO and it's these DAOs have $100 million treasuries, wow, that's a lot of money, but that's not, first off, fully realizable. Second off, again, market conditions fluctuate on a dime, as clearly know if anyone's been in the industry for more than a couple of years. Thinking about it from a corporate finance perspective just makes a lot of sense, where it's let's actually think about a runway. What do our expenses look like? How can we actually, earn some yield to have more sustainable cash flows? And, even though we're reinventing the wheel of how organizations work, in a sense, we can take a lot of lessons from what we've been doing for hundreds of years.
Yeah, exactly. I can't imagine running a startup and having to think about the daily value of my corporate treasury going up and down by 5 to 10%, and in some of the worst days 30 to 40%.
Yeah, no need to add more stress in a already quite volatile, stressful industry. I would love to talk a little bit about the BD process when you work with protocol teams. So, right, coming from sort of the enterprise SaaS world, right, there's a tried and true playbook for this, right, where you find the key decision maker, right, work through budget, make a selling point, and if you get them over the line, you send the DocuSign, all's well and good. Obviously, it's a little bit different in crypto, so I'm kind of curious, what was that like, getting accustomed to some of the nuances of working with protocol teams?
Yeah, I mean, you nailed it. It is quite different from any traditional type enterprise sales role or any other type of sales role you'll ever encounter that is not in crypto or in DeFi. And I think Gauntlet was one of the first ones to actually sell a product or service to a DAO. And it kind of dates back to Compound, where Gauntlet had received a grant from Compound before Compound became a DAO. And then at some point, Compound was like, hey, we're giving this DAO thing a try. And I think before that, it was only the DAO. So I don't think anybody really thought it was going to work. But we said, all right, what can we do to help? They said, well, we want to pay you through the DAO. And so, as they formed this DAO, we put together a DAO proposal, and we ended up kind of routing our contract through the DAO. And so I think it became, and kind of coined the term B to DAO. Ever since then, you see a lot of this happening. It's pretty common practice. But yeah, quite different in a number of ways. I mean, to your point, you're not just selling to one or two decision makers, you're selling to an entire community of people. And, for better or for worse, those communities aren't always qualified to make certain decisions, to put it right. I mean, they are for certain things. You do have a lot of people who understand risk management in DAOs. You do have a lot of people who understand incentive optimization. You also have a lot that don't. And they kind of just look at price tags, or, they kind of just don't see a need, or they say something like, oh, we can hire a risk guy in-house. And, for any type of product you're selling to a DAO, regardless of what we do, there's always going to be a segment in a DAO that really understands it and a segment that doesn't. And so it's finding ways to educate the holistic DAO and disseminate, what can be highly technical information to somebody who understands it, to also to people who may not understand it as well. In DAO forums, you're selling out in the open. Everybody knows your contract prices. Everybody kind of knows your secret sauce to an extent and how you go to market. You're at the whims of voters. You're refreshing snapshot or refreshing on-chain votes every 5 minutes, trying to see what votes come in, if your deal is going to go through. So the dynamics are entirely different, but that's actually one of the things that drew me to Gauntlet, is I had seen that, and it was kind of like a new challenge, and I thought it was interesting. And I had no idea it would catch on as big as it did today, but it has become largely the standard in how business is done between service providers and DAOs.
So, Matt, you're telling me that the anonymous frogs on the forum aren't qualified to make decisions on agent-based simulations and deciding an ROI from such a service?
Some anonymous frogs might be quants that I don't know about. So I'm going to give you 20% might be. I think it tells a lot when you see it in governance forums too, because it's all in the comments. So sometimes you'll just see price too high, and sometimes people will ask us like, why don't you reply to that? Like, well, it doesn't really seem like a productive comment to reply to. I mean, price too high relative to what? Like, what is your alternative to protecting your money and making sure that your DAO and protocol is run kind of as it should? Then you also have like really thoughtful questions for people who understand what you're talking about. And we're more than happy to engage and try to educate where we can and where we feel it's necessary.
Yeah, that's something we've seen a number of times, right? Having gone through sort of a dozen plus like governance processes where a lot of times people are like, oh, $100,000, like that's so much money. Like, no, too high. And it's like, okay, well, you think about a lot of these protocols, these are like cash flow generating entities where the right services can provide multiples on that, or especially when you're talking about getting into the risk world where it's like, well, this is millions, hundreds of millions, hell, sometimes billions of dollars at stake where, like the work that needs to be done is resource intensive. So sort of requires this type of spend and resources if you want to run that like a professional organization.
Yeah, exactly. And, we try to take it all in stride, try to take it with a smile. I mean, frustration is not a good look on anybody. And so try not to really let any of that stuff phase us. I mean, at the end of the day, we want to provide a service. We want to align incentives with DAOs. And sometimes that works out and sometimes it doesn't. And I think, that's the nature of sales no matter what industry you're in.
From like a governance efficiency process, like, do you think there's better models than sort of just token holders being able to vote on service providers where you can have, more of like the subject matter experts making the decision of like, hey, do we work with Gauntlet or XYZ, or like, is it worth this spend versus just like any single token holder or person on the forum chiming in?
Yeah, and I think we see that already with some DAOs. And so some DAOs will elect committees that are elected but highly qualified to make certain decisions. Maybe that's a treasury committee for treasury decisions. Maybe that's a risk committee for hiring a risk manager. Maybe that's an incentive committee for incentive-based decisions. And so I think I've seen that work pretty well, and I think those conversations are generally pretty productive. I also think like DAOs will continue to evolve. There's a lot of experimentation going on with things like Futarchy, MetaGov, MetaDAO, like a lot of these different platforms that are continuing to grow. And so I think the committee thing has definitely brought us along quite a bit, but I'm excited to see what comes next as well.
Totally. Yeah, I think anyone that just writes off DAOs because they see the messiness that goes on now, and it's like, oh, clearly this can't work. But I would never want to bet against smart people innovating and experimenting and like doing this in real time where sure, a lot of these models might not work, but there's enough people trying this with real money at stake that over time, some of them will become sort of more Lindy, more just advanced and resilient. So I guess on a related note, so working with these DAOs, like how do you guys think about being able to accept tokens, but also having to then like manage fiat-based expenses, right? Because, you guys aren't a fund yourself. You don't want to just be taking a bunch of tokens, then turning into like a pseudo venture fund. But sometimes projects think, or, community members would be like, oh yeah, these guys are just dumping our token. Like, what the hell?
Yeah, I mean, it's definitely a fine line. And I think we've seen other service providers that maybe lean too heavily on the token model and encounter a lot of financial difficulties as a result. And we always want to ensure incentives are aligned. Like we want to share in the success that, we're providing to a DAO. We want to see DAOs grow. And so we generally have a healthy mix between, what we can do along the lines of, USDC or native token or, a fee element to it. It really just depends on the DAO itself, on the protocol itself, what are the certain mechanics of the DAO, have they fundraised, things like that. And so it's very much case by case basis, but generally speaking, we try to get as flexible as possible to align with those we want to work with, because if we're trying to work with you, we generally think that, you're a protocol that's going to grow.
Yeah. And do you guys get involved in governance much yourself and sort of chiming in on other core service provider decisions or, other conversations, votes going on?
Yeah, we do. So we've been involved in governance across a lot of different DAOs, dating back to kind of when Uniswap launched their DAO. So Tarun, our CEO and founder, was one of the initial delegates in Uniswap, and that carried over to Gauntlet over time. And so right now, I think we are delegates in Uniswap, Arbitrum, Optimism, and Jito, and we're exploring a few others currently as well. And really, it's for a number of reasons. Like, we want to, one, be a good steward of DeFi. I mean, our business is built on DeFi, and we want to see it be successful. We want to see it grow. Two, I think we bring a lot of unique insights given what we do as a service provider. And so when you think about a lot of the rigorous quantitative work we're doing, we can bring certain insights to proposals that maybe others don't have, but also can help educate others on how to think about making decisions. Three, just being around as long as we have. We're kind of like a dinosaur in DeFi. Like, we've seen a lot, we know a lot, and so bringing that experience to governance as well is something that we think just helps DAOs overall. And I think we love interacting with other delegates. We're pretty active in these DAOs governance forums. We're active on voting, communication, et cetera. And so I don't see us slowing down there. I think, again, we want to be a good steward of DeFi. We think governance and delegation, et cetera, is a big part of that.
And how would you assess sort of the ROI of that governance participation, right? If there's other people maybe on a BD team or working at companies where, they're looking into providing services to protocols and participating in governance, because obviously there's a resource expense to having people actually sitting on those forums, continuing to vote. Would love to hear a bit more about that.
Yeah, I think prior to, maybe the last year and a half or so, the ROI really came from credibility within DAOs, meeting a lot of new protocols, meeting a lot of new delegates, building relationships across DeFi that really built a lot of trust with the folks that we work with or want to work with and want to serve ultimately. And so as you get to know us as a delegate in governance, you start to understand how we operate, who we are. And so if we do decide that, to have conversation with people and working together, we have a lot of things to point to, whether that's our direct relationship with somebody or just even going to governance posts, et cetera, because a service provider isn't there just to fine-tune parameters or just to make certain decisions on behalf, of changes to the protocol. It's to engage with the community. Like, you should be part of the community as a service provider. I think our experience in governance forums really helps us do that in a way that we can connect deeply with these communities. What we've seen maybe over the past year and a half or so is the notion of paid delegation. That, is something that popped up in several DAOs that are looking to attract higher quality delegates, incentivize more delegate activity in general. And so as you think about that, that's a direct kind of ROI on our activities. And so, that allows us to expand our team if we have people, and allow people to dedicate more time to it if we actually have kind of compensation coming towards Gauntlet's way. And so I think it's been a net positive overall. I definitely think there are some fine tuning and tweaks to these programs to make them more efficient. But overall, I think that's going to increase participation in a lot of these DAOs, bring in higher quality conversations and delegates or otherwise.
Yeah, absolutely. As seasoned as you could be in finance, as smart as you can be, like there's nothing that can really replicate just being in it for years, experiencing, Black Thursday in 2020 or like some of these other like big crashes that led to like large scale liquidation events where it's like we got to see things play out in real time. And having that context, I think, is just super important when it comes to, the value you can continue to provide. So.
Yeah, I mean, there was a reason that we worked on Maker's 2.0 auction mechanism after Black Thursday. They didn't go to JP Morgan or BlackRock. They went to the guys who were doing the hard math in DeFi. And so, we were proud to work with them on that and really proud of the work that we've not only done with them, but everybody else. Mm-hmm.
And so what maybe keeps you up at night in terms of like the health of this type of business? Like, are there any big risks where that could make DAOs like not need to spend money on this function, or anything that worried about or just like risks out there?
Yeah, I don't think about it as much as what pertains to our direct business with DAOs or other protocols. I think it's more so for DeFi and the industry as a whole. And it's something that is probably the most vanilla answer anybody's going to give, but I think it's the most obvious, which is regulation. It's a very uncertain regulatory environment, especially for those of us here in the US. And so I don't think about it as much as like, will a DAO hire Gauntlet? I think about, crypto and DeFi continue to thrive in the US. Will continue to thrive in other countries that are more restrictive. Because, if that starts to slow down and that doesn't grow, then obviously it makes it very hard for us to grow our business. And so, it's been nice to see some innovation in the space, in other countries who have been more progressive with their regulation. I think, while I don't see any massive changes, coming next week for the U.S., there's definitely, people in the Senate and Congress, et cetera, who have been vocal supporters of crypto. And I think, that's just the start. We have to continue doing that. And I think that starts with continuing educating, the governmental bodies, et cetera, about what we do and why it matters. And, it's not all kind of shit coins and rugs. Like there is some real innovation going on here. And, we want to continue to help kind of grow it.
Totally. I think if every senator, everyone in the House in the U.S. could just sit down with some folks that are actually like building, and particularly on like the risk side, where it's like understanding that there's a lot of well-intentioned, very effective, smart individuals like working to make these systems safe. It's not the Wild West they make it out to be. That would definitely be a positive force in the regulatory landscape, because it's something that keeps us up at night as well. But hopefully we have some positive forces going there.
Yeah, I mean, I guess the last point I'll say there is like, it still astonishes me that things like payday loans are legal and allowed to thrive while crypto is seen as the bad guy. And you just see people get into these massive debt spirals. They never get out of it. I'm from a place where there's more payday loan centers than there are McDonald's. And that's saying something given how many McDonald's there are. And so they're just preying on the lowest income people in the US. And meanwhile, crypto, for the large part, I think are good actors trying to build financial products that democratize access to not only lower income, but anybody who wants to kind of get into the space. And so I really think and really hopeful that people start to pay more attention to it and give it more of a thoughtful eye.
Totally. And it's also something, right, where regulators spent so much time in the financial system post '08. And it's like, okay, well, if you look at DeFi, right, it actually almost becomes like impossible for that to happen, because like you can't mask risk like you could when banks are peddling, right, these wildly like kind of complex CDO type structures, where it's like right now, like all of these like loan instruments with guys you're working with like Morpho, like Compound, you can get a real-time look at like every single loan that is part of this bucket, all of the live collateralization ratios, where they're getting liquidated, such that like you can have a more transparent look in a way that's never been possible in the financial system.
Yeah, I mean, look, we had the last couple of years, banks have just gone down out of nowhere. People couldn't get their money out. Like that doesn't, you can see everything going on in the US or on chain. You can pull your money out of a lending protocol whenever you want. You don't have to wait between banking hours. You don't have to hope that they have your money somewhere. And so, yeah, I mean, again, obviously you and I are trying to fight the good fight here. And I think a lot of people in crypto are. And the more we just stay dedicated and true to it, I think the more we can expand it and get some more optimal results.
Absolutely. So one more question for you. So I asked what keeps you up most at night. So maybe on the flip side, like what are you most fired up for when it comes to kind of the state of the industry or stuff Gauntlet's working out, call it in the next 12 months?
Yeah, I think coming out of like the Asia conference circuit of Token 2049, Korea Blockchain Week, fantastic events. I think there's a lot of capital on the sidelines that is pretty close to coming into the space in a number of different areas, whether that's Bitcoin restaking with things like Babylon, whether that's more restaking like Eigenlayer, whether that's coming onto Solana for like Jito restaking. So I think restaking is a sector that I expect to grow quite a bit more. And I also think things like lending. You see new models like Morpho. You see new models like Euler. Like you see these innovations on lending that we hadn't seen for years. And so I'm really excited to see how those kind of grow and give users other access. That's not to say that Compound, Aave, and other protocols aren't built well and they're not providing a good service. They absolutely are. But I think it's really nice to give users different options on what protocols they can use. And they all just need a certain scale in order to actually be useful. And I think Morpho is bringing that. I think Euler will bring that and others. And then finally, just as I was talking about earlier, like I like what we don't know yet. Like what keeps me excited is there's so much that we haven't seen yet being built on chain, new innovations. And I really like the white space in the industry. And I always have just like what is going to come next. And especially at Gauntlet, just like excited to tackle it as well.
Absolutely. So we got more capital coming in, financial innovation, and things we haven't even thought about, or even things that might like resurface that might have existed before, never got traction, and then pop up again to surprise us as the next new hot thing. So no shortage of things to be excited on. Thank you so much for coming on, Matt. This was an awesome conversation.
Oh yeah, thanks a lot for having me. Really appreciate it.